Welcome, everybody, to episode number 17 of the Wide Lens podcast. I've got Matt Rigby here with me again today.
Co-host still?
My co-host.
I've dressed up for the occasion.
You have dressed up for the occasion. I was wondering how this was going to go.
I need to step up my game.
Recording this on Friday, the 20th of April. Matt's trying to fool me again with putting 19th in the doc. It is the 20th of April. Episode 17, we're going to cover the latest topics in financial investing markets, and we'll get cracking into Matt's Market Minute.
All right. So interesting week. The last 5 days, the Aussie ASX 300 is up 1.8%, still down for the year, down 7%. Some earnings that have come out over the last few days. So Webjet came out, I think it was yesterday, up 8% for the week, came out with a pretty positive outlook. I think they said the European bookings and flights business was above pre-pandemic by a fair margin.
Really?
Yeah.
Booking numbers?
Booking numbers. So they've got I think it's called beds.com, where you just book hotels, obviously. But yeah, the numbers and revenue were both above pre-pandemic, which is good. Coming into summer, I guess that's probably positive. Aristocrat came out with record profits, record revenue. Apparently people are still gambling. A $500,000 buyback, up about 8% for the week. And New Farm, the chemicals and I don't know, what do they do? Fertilizer business, down about 4%. Interesting, Woodside, BHP, both up a little. So for those who aren't familiar, BHP are selling their petroleum business to Woodside. That got approved yesterday. Interestingly, though, it was approved by a fairly strong margin, yet Woodside shareholders gave the board a bit of a rap over the knuckles for not being ESG enough and sustainable.
Woodside shareholders are not ESG.
You're approving an increase in the oil business, and at the same time, you're saying you guys aren't sustainable enough. It just seemed like a bit of a contradiction to me.
Did you see how, and we're probably jumping around now, but Tesla got removed from the S&P 500 ESG index?
Yes. Elon was not happy.
Do you know who the number one stock is on that index?
No.
Just take a wild guess.
Well, I'm going to say, I don't know.
The number one ESG company, S&P 500.
Surely it's renewable energies.
ExxonMobil.
Well, that makes sense, right? Seriously? It's the number one?
It's ExxonMobil. So ExxonMobil,
wow, okay.
And Tesla gets booted out because of some workplace issues, automated cars crashing.
Wow, okay. I'm sure there will be more about that.
You look at Elon's tweets, he's cracked the shit. He reckons it's a government conspiracy.
Don't know about that, but understandable, cracking these shits. All right, let's get back to it. NASDAQ 100.
Hold on. Isn't Tesla, their whole company and their whole philosophy is based on renewable energy, not renewable energy, but sustainability, the environment, the planet. That's like their whole ethos.
Absolutely.
And to be kicked out of
the ESG
index would be gut-wrenching.
Yeah.
All right, sorry, man, keep going.
So the NASDAQ 100 are down 2% for the last 5 days, down 28% year to date. 76 stocks down more than 10%, so slightly less than last week. 11 in positive territory. And you asked me last week who they were. So a couple, Kraft Heinz is up, AstraZeneca, Amgen, T-Mobile, Regeneron Pharmaceuticals, Activision Blizzard. So just none of the big tech names, which maybe isn't surprising. Anyway, S&P 500 down about 1.5, down 18.5 for the year. Some earnings that have come out, and we'll talk about some of these in a bit more detail, but Target, they missed, down about 30%. Walmart missed, down about 20%. And Global E Online, down about 6%. They're kind of a cross-border payments provider, facilitate cross-border transactions for smaller businesses. Companies that beat, Take-Two Interactive, Home Depot and Lowe's both beat, but their shares are down. C, which is Southeast Asia Limited.
Hold on, wasn't your outlook that the Bunnings bet was supposed to continue. Remember that?
I do remember that.
Did you put money on that trade?
I did not. 1 month is not a trend.
Oh, okay.
Yeah,
Sure.
The earnings beat. They're seeing an increase, but
Yeah.
it's inflation that's getting them, which is getting Target and Walmart
of
as
course.
well. That's what I'm sticking to it. Anyway, C Limited up 19. JD.com, the Chinese everything company, up 8%. TJ Maxx up 8% and Costco down 14%. Interesting.
I reckon TJ Maxx is the one to look out for, just in
Yeah.
light of maybe some of the other stuff we're going to talk about later.
Yep, absolutely. Emerging markets flat
Did
for the last
Costco
5
also
days.
buy like a TK Maxx or TJ Maxx?
No, they've got like Costco, Sam's Club. So they're just wholesale groceries, big box, buy a whole lot of
But
stuff.
don't they do clothing? I haven't been to Costco in a long time.
Yeah.
But they've got like Puma and they've got Adidas and they'll have, these brands on
Do they
sale.
have those brands?
Like,
Okay, I
it's like
didn't
an
realise
Aldi, like a special for the week.
Yeah.
Whatever we've got sold out, and then
Okay.
maybe
Yeah,
not.
I thought that was their brand, only their brand.
No,
stuff
I bought like
for the
Adidas
clothing
shorts and stuff
Okay.
from Costco, yeah.
Yeah, I didn't realise. Okay. Maybe that's a market they can get into. Emerging markets down about 14.5% year to date, flat for the last 5 days. Oil, it's up about 1% the last 5 days, up 49% year to date, trading $111.
Have you noticed the price of
Petrol
fuels?
is off.
What's going
the
on,
bloody
man?
Charts. I don't know.
One
think
minute it's
they're-
$1.69, next minute it's $2.09. What the hell? Like overnight.
And it hasn't moved. I mean, it's been at $2 for the last week. Maybe they're trying to sway the election result, going pro-Labor.
I don't know.
And Bitcoin, everybody's favourite topic.
Did you buy it 20,000 or has it not hit
mate,
20,000?
It's not low enough yet. It's going lower.
Did it hit 20?
No.
All right. So it was 30 last week still. Right.
Yeah, it's pretty much flat where it was last week.
Oh, flat. Yeah.
Down 37% for the year to date at 30,091 US dollars.
Well, you know what the thing is, right? Like all these other coins, stable coins have capitulated. Bitcoin's still alive.
What's the other big one?
Ethereum.
Ethereum's down 51 odd percent. Yeah, and again, I don't know a lot about cryptos, but from my reading, that was the one that was meant to hang around for longer and be a bit more useful going forward.
Did you see the, his name, Changpeng Zhao, who's a founder of Binance, the crypto exchange?
Oh, yes. Yeah.
So he tweeted saying he's poor again. His holdings in Luna, he was worth 1.6 billion.
His holdings in Luna were?
Yeah.
Right.
Guess what it's worth what he's worth now after the crash? I don't know, him or his coins, whatever.
Like 50 million.
$2,000.
Oh my God, are you kidding me?
1.6 billion crash, now worth just $2,200.
Yeah, you're probably justified in feeling poor.
Let's roll on.
That's nuts. Okay, so retailer earnings in the US. What happened Wednesday night? So Wednesday in the US, Target came out with their earnings announcements, and they actually, on the surface, they didn't look too bad. So they reported an increase in revenue, and their revenues beat expectations.
Yeah, I saw
the
that. Yeah,
issue
yeah.
was that their profit missed, and probably the bigger issue is that their margins, their profit margin fell 400 points or 4% from 30% down to 26%. So that's really, you can...
Inflation. So they're not
Sum that up in
passing,
one
they
word.
can't pass that on to the... So you know how we've
They
talked...
can't pass it on quick enough, I think would be the view.
So we've talked about, it was Nike, McDonald's who were...
Chipotle.
they were passing on hikes and CEOs are coming out and saying consumers are paying. It's no problem.
Yeah.
And they were maintaining margins, but
Yes.
it appear. Are you saying now that it's starting to hit maybe some of the retailers who are...
It appears to be, and maybe Target, Walmart were another one where they got hit. I don't know what their margin change was, but certainly they had kind of that same sort of theme. They're targeted at a specific demographic, and maybe that demographic is
Are people like
pulling back.
rebelling? Like, not so much rebelling, but like, no, we're not going to go and buy that thing anymore because just
'Cause now
price
it's too
is
expensive.
It's too expensive.
2 weeks ago, it was $200. Now it's $230.
Or the
I'm
fact
not willing to
disposable
pay.
income is coming down with the cost of fuel, for example, still remaining relatively elevated. Now,
Yeah.
I think in the US, has broken records of historical prices.
Yes. Yeah, for gas or petrol, as we would call it. But yeah, no, absolutely. It's at or near all-time highs in some of the states, if not across the country. So that was interesting. And we'll just bring up this chart quickly of Target's daily performance since 1980 through to 2022.
Wow.
And there's only one instance prior to Wednesday where the stock has fallen further in a single day. I think at its worst point, it was down 26% on Wednesday, finished up about 21% down for the day. And
so 1987 was the
87
on pace
crash.
for largest one-day decline since 1987 crash. That's pretty big.
It's massive. I mean, that's huge. And Target, post the fall, the total company is worth about $75 billion US dollars. So they're not a small, tiny retailer. I mean, they're pretty major. And I'll bring up this next chart, which is Walmart. So this is on the same day. They were down 11.38%, almost in sympathy. So they reported the day before, and the fall wasn't that great.
So this was after Target
After
announced.
Target announced, yeah.
But Walmart had already announced earnings.
Yes.
Right.
Yeah. So Walmart, I think, maybe it was more the commentary from Target CEO, whose name I can't recall, but so Walmart basically went out in sympathy, and they're a $337 billion company. They're like a top 10 in the US, I think.
That drawdown looks more in line with previous drawdowns, though.
Previous major
drawdowns for Walmart, whereas the Target one just looks really out of
the blue.
Yeah,
Yeah,
it doesn't look right, does it?
No, absolutely not. Some of the other major retailers in the US that were down, so Dick's Sporting Goods down 14, Best Buy, I think JB Hi-Fi, down 10.5, and Bed Bath & Beyond down about 8, almost 9%. The exception.
See, your thing about renovations and things, look at Bed Bath & Beyond. I mean, I know that's sort of smaller things, but you'll think JB Hi-Fi, like who's buying stuff? Who's buying appliances? I don't think that's going to happen, man. I think
maybe not.
I think that train's well and truly
Left the station.
Yeah. Did I put money on that trade? No.
No. The one that we kind of alluded to earlier, TJ Maxx. So this is they buy clothing from the major retailers who can't sell it, so overstock and sell it at a discount. So they're doing quite well, and they. I was reading this morning, they have this position where they've got tons of inventory coming in from everyone who's ordered previously. Shipping has been delayed. It comes in. They've got too much stock on hand, so they're able to then pick it up from, let's say, Walmart or some of the other big retailers at a discount and then sell it at their normal discount with their normal margins. And they're still seeing a good, healthy number of people come through the stores. So
they're up or
the
down?
Bargain shopper, they're up. What was their... Did I have... Yeah, they're up 8% for the week.
Yeah, right.
And they came out with earnings and they beat.
That's
earnings.
notwithstanding what Target came out with as well.
That's right. Yeah.
Yeah, that's really interesting.
Yeah. So look, they're holding up relatively well, which.
So what do you think happens with if we're over if the likes of Walmart, Nordstrom or whoever these bigger retailers are, they've got stock, they're going to TJ or TK Maxx. Is there what happens to prices though? This concept of consumers not buying from Target or not buying from Walmart because of cost of petrols, is there an aspect of a deflationary impact if people aren't buying?
Yeah, potentially. I mean, I guess if you're Nordstrom or your Macy's or any of Bloomingdale's, any of the big retailers over there, you've got one of two choices. You sell it, or three. You sell it at the price you wanted to sell it at, getting towards end of season, so you're probably not going to get that price. You sell it at a discount, to your point, that's a deflationary decision or move. Or you sell it on to the discount retailers like TJ Maxx. So and that also pushes those prices down because they're able to buy it lower at a lower
Sure.
price than what they used to, and presumably they pass on some of that drop. So
We talked about this
potentially
a
it
number
does.
of weeks ago, didn't we?
Yeah,
About TJ Maxx was seeing themselves the beneficiary of all of the shipping bottlenecks.
Yes.
And now it looks like prices are going to be another bottleneck, and inflation hurting the likes of Target and them becoming another beneficiary.
Yeah.
I reckon there's room to go here. That's my
yeah,
feeling.
I think there probably is as well. And something else that's really interesting is I think it was the Fed. I can't remember, I'll read this and then we'll work out who it was. But so there's Bloomberg reporting that US consumers are shifting their spending from merchandise to services.
What does that mean?
So instead of going into shops, they're going to cafes and restaurants,
right.
That sort of thing. And that's interesting because any inflationary increase in the services side of the economy is a lot stickier than an inflationary increase in the retail and clothing
Why
side
is that?
of things. Well, you think about if you go into, so the retailer is buying goods from somewhere else and selling it. If that price comes down, they typically, or goes up, they'll pass that on. But if you go into a service provider and say you go buy your coffee, it goes from, I don't know, what's coffee, $5? $5 to $5.20, and prices come down. They're not going to, or they're unlikely to drop that price back to $5. They're going to keep it at $5.20
Right.
and make that a little extra margin. So historically, service
Like petrol.
absolutely like petrol. Service inflation's a lot stickier than merchandising retail inflation. So that's interesting, and
I wonder if
maybe an issue for retailers.
the per purchase ticket is also a lower ticket than the likes of a merchandise transaction. I don't know.
Yeah, don't know.
Maybe
Yeah, not sure. So this is just a chart I found this morning from Statista, or a graphic, I guess is the right term, on how inflation changed the price of a hamburger. So we'll bring this up now. It's quite interesting. So from April 21 to April 22, this is based on the Bureau of Labour Statistics. This is the...
Do you know who
kind
the
of-
role is? It's Ukraine and their wheat. That's what that
Possibly.
10% is.
Man, so I saw this and kind of just laughed and said, well, you don't think about it. So the roll, the lettuce, tomato, bacon, the beef, and the sauce, I would never have thought. But, they're all up. Tomatoes...
Sauce is just sugar. So
Yeah.
price of sugar's gone up, is it not?
So apart from tomato, they're all up about or more than 10%. And I think that kind of explains, where we're at these days. One last thing, and then we'll kind of move on. So Jay Powell, Fed chair, came out on Tuesday saying that no one should doubt the Fed's resolve to quell inflation, and quoting, "What we need to see is inflation coming down in a clear and convincing way, and we're going to keep pushing until we see that." So that's pretty interesting. I mean, that kind of says to me
quite
that
aggressive, like
very
meaning
aggressive
rates are just going to keep going up.
until we see prices coming down. Now, if prices, for the most part, are out of most retailers' control, it's not relating to demand, it's more supply. How far do you go? We've got Chinese lockdowns, so...
Do you think all of this
I
is
don't know.
still to do with supply chain?
I think a lot of it still has to do with supply chain. I
So
really
are
do.
we still in this? Are we still transitory?
Yeah.
You
We
can
are
still-
till we aren't, right? I don't know. I think we are. And that, I'm sure there'd be a million people that would probably laugh at me for saying that. But I still think as long as there are supply chain bottlenecks pushing up inflation, then that to me is transitory. That will ease at some point. Now, the Ukraine and Russia, that hasn't helped things. But China's COVID zero policy is...
Massive.
Although we're not seeing news about supply chains tightening up again. If anything, that they're staying the same. Like the supply chain issues haven't gotten worse.
But it's not getting better either.
But it's not getting
I think
better.
that's the issue. I think that there's. I was reading there's Chinese chip manufacturers talking to Apple and saying we are not going to get these chips to you guys for these products because of because of
Yeah, right.
issues. I mean they can't get people to work.
Yeah.
They're in lockdown with fences surrounding
Their
buildings.
Yep. Dan, Andrews, I hope you're not listening. That's how you do a lockdown.
Look, let's jump into the 2000's feeling. And there's a lot of analogies being made and comparisons being made to that of the 2000s. So I did a bit of research, and I kind of want to just start to describe the situation, and then I want to get your point of view. So we've got a robust jobs market. The Federal Reserve's raising rates at quite a rapid pace. We've got a very hot financial markets that has obviously started to correct themselves. And the frothiest sectors are the ones that are getting clobbered the hardest, primarily being tech. Now, that's obviously the situation today, and that was also a very similar situation in that of the year 2000, when we obviously had the dot-com bubble busting.
Yep.
Now, we all know the recession that followed the dot-com bust, but what I don't think many people know is that the fact that the recession happened a full year later, not during the year 2000 when the dot-com stocks busted. And so just for some key milestone dates, so back in 2000, the stock market peaked in March of 2000. Now, the year progressed and obviously things were looking pretty bad, and especially for tech companies that were just burning through money, right? And so we started to see stocks fall throughout the course of the back end of that year. Companies started laying off employees. IPOs were being shelved, and companies that had recently gone public had just seen their stock absolutely clobbered, a la Peloton down.
Or SPACs.
Or SPACs, correct. Now, what was happening throughout the physical economy that year, the economy was still quite robust and still quite strong. And I was looking up the numbers, I couldn't find these stats, but most people weren't working for tech companies, I wouldn't say. Tech companies now represent about 12.5 million US workers out of 165 million employees, or those employed in the US. So it's about 7% employed by tech companies. And corporate America, though, was still quite bullish. They were still investing and they were still hiring. Now, in April 2000, jobless claims reached a multi-decade low. Inflation hit, I think, close to 4% during March of 2000. The Fed started raising rates. And it was only a full year later in 2001 that the wheels fell off the economy effectively. Companies started cutting spending, laying off staff. And now we are seeing staff layoffs at the moment. And a lot of it is now, currently a lot of it is specific to tech and the tech sector.
Yep.
And then so we saw the recession happen a full year later. In fact, the recession wasn't that bad. It wouldn't have been that bad. The problem was, if you remember, in 2001, we had September 11.
It's kind of hard to forget.
And so what happened was you had this recession period, and then as you're sort of coming out of that, you have September 11, and things just got worse. We all know what happened from there on in. Now, so it may be that we don't see a recession until 2023, and I think that's what the likes of Deutsche Bank, JP Morgan, and some of the other majors are coming out talking about.
Yep.
But the other thing is, we may very well be in one right now. We saw negative growth in Q1.
Yep, in the US.
In the US. And so we're not going to know until the end of Q2, until the data comes out, which will be a month following, whether or not we were in a recession.
Yeah.
And so that could be entirely possible, and we're not going to know until after the fact. A few key things that I've had a look at and I think are probably really interesting to keep an eye on is whether companies outside of technology start laying off and start reducing capital. So if the likes of, forget whether Robinhood or whether these crypto exchanges or whether Peloton or Netflix are cutting staff, forget them. Are Target going to cut staff? Are Walmart going to cut staff? Is Starbucks cutting staff? I think the interesting thing is to look outside the tech sector. Yep. We've obviously talked about how strong the US consumer is. Now, we saw the same thing happen in 2000 where the economy was still strong. And so it may very well be that we can have a recession, but the economy is still quite strong, albeit we have negative GDP growth. And a couple of other things that I was just thinking about was, and we saw this in the GFC, was obviously we've got the stock market capitulating, but then you've got bond market defaults. Talked about, as of earlier this morning, Sri Lanka came out and had defaulted on, or we're restructuring one of their bonds, and technically that's a default. We're seeing it in Russia, we're seeing it in China. I think they're sort of isolated, but really interesting to see if there's further defaults in the corporate bond market in other areas of the market. And this was quite big in the tech sector, in telecom in 2001. And finally, the other one I was looking at was business confidence. It tanked in 2001, it tanked in 2009, and it tanked in 2020. It has peaked. I was just, as of early as of last night, looking at the OECD Business Confidence Index, and it's sitting at about 101. 100 is long-term average, and it has peaked. It's coming down to a decline. If it's got anywhere to go, like we've seen in 2020, 09, 01, there's a long way to go for business confidence.
Yeah, right.
But again, business confidence can continue until well and truly after a recession has been done and dusted.
Yep.
So I'm curious, what do you think as it relates to analogies and comparisons being made to that of 2000 and the talks of recessions? It's pretty high, the odds are pretty high that we're going to have one, right? And so it can be a mild one, but I'm really curious, what do you think about that?
Yeah, I think you're right. The odds are high that we will have one. I mean, we will have one. It's just a matter of when.
When and how long it lasts,
yeah.
how bad it is.
Yeah, as it is always. And look, what's interesting, we've kind of talked about this earlier, that consumer confidence is rolling over, but consumer spending is still increasing. And I think you pointed this out quite a while ago.
I've got a chart on it later on, actually.
Okay.
Yeah.
But yeah, I mean, I think that's some of those forward indicators are really interesting to look at. It's funny, with time I was working in 2000, 2001, and I remember the tech wreck bursting, and I don't remember the timing of everything, but now that you go through it all, it kind of makes sense. And yeah, maybe we've had that bubble burst, and interest rates are rising as they were during that period. And I mean, it's really starting to smell and feel and sound a little bit like it did back then. Hopefully we don't have some big event like September 11 to kind of tip us over the edge. But it would be interesting to kind of, I guess, look at this 6 months down the road. And you're right, the US could be in a recession right now. We won't know till July or August.
That's right.
And I mean, what do you think the Fed will, let's say we get to August, GDP for Q2 in the US is negative. So there's 2 negative quarters. Does the Fed keep being aggressive as they are? If you're technically in recession and inflation is still rising and unemployment is low, I mean, it almost feels like that can't actually be the case, but obviously it could. Does the Fed continue to raise rates and potentially push the economy further into recession? And I guess once consumers see recession on the front page of the newspaper or whatever, that also has a almost reinforcing effect.
Yeah.
Do you think the Fed keeps going?
I don't know, and I don't think it matters what I think.
Come on,
the Fed
give it a
keeps
shot.
going. I don't know. Like, if inflation is still, and that could very well be possible.
Yeah.
Because consumer spending can continue during the 2000s. The 2001, consumers kept spending, and so the consumer was still okay.
Yeah.
And if you look at consumer expenditure index, it actually just kept rising, albeit at a very, very slow pace.
Right.
But there wasn't this quarter-on-quarter decline at any point in time.
And they're cashed up at the moment.
And in fact, now, I mean, that could be an even more likely scenario, because we are now more cashed up the consumer is more cashed up than they have ever been.
Yeah.
In history.
Yep.
And so are corporates.
And employment conditions are strong. So you could get this almost opposing, we're in recession, but conditions are still strong. Yeah,
which is bizarre to even try and actually make sense
around
in your head.
Yeah.
But it is absolutely possible. And I don't know, maybe we just need to we've said this before, we just need to let a ton of air out of this thing for it to just come back down to some sort of normal level. And I mean, how else are central banks supposed to curb inflation?
Yeah, well, they
the
only have a couple of tools, and they're
it.
pretty blunt, and
That's right.
They're not targeted and specific. So
let's maybe keep going, because I think we're going to touch a little bit more about that. I think I dodged your question.
You did nicely. All right.
Look, I'd say rates will continue to rise.
Yeah.
That's what because even though you're technically in a recession, it's probably quite mild. And so just because you're technically in a recession doesn't mean you're not. It doesn't mean a whole bunch of other things aren't playing out, like consumers keep spending, like inflation continues to rise. So I think, I mean, I think that is all entirely possible. But who cares what I think?
Well, I don't know. Maybe people out there do. Who knows? We'll find out. All right, let's move on quickly. We've got an election this weekend. As I realised, I didn't send in my postal vote application, so now I have to go and line up, and that just annoys me. But anyway, so the Liberal Party have come out with a plan to allow first home buyers of any age, I believe, get into the property market using their super. Now, this is something that has been talked about for I don't know how many years. It's been rumoured, it's been kind of talked about and shot down and whatever else. But anyway, they finally come out with something. So there's two policies they announced. One is they're planning to lower the age threshold for the downsizer contribution. So if you recall at the last budget, it went from 65 to 60.
Yes.
They're proposing down to 55.
Okay.
But the second one is the one that's a bit more
What do you think about that, if that's the little one?
I don't have a problem with it, to be honest.
It's a good idea, right?
I don't see why not.
I know some people put the sale of their house on hold for a few years so they can actually
access it. So why not? And you know, the 1.7 million caps, I mean, it's just such an arbitrary number. There was a formula behind it, but why not let people get more money into super and reduces the chance of being on, unemployment, the Centrelink. So I think that makes sense. The second one is the super home buyer scheme. So it will allow people to invest up to 40% of their super to a maximum of $50,000 to buy their first home. So some of the key aspects are only first home buyers, and they must have saved a 5% deposit.
So you have to stump up your 5% yourself.
And then you can borrow 40% of your super up to 50K.
50 grand.
So you've got that. Available to home buyers of any income. That's interesting. And couples can use their combined savings. So husband and wife can both pull out, apparently,
50 grand each.
And applies to both new and existing homes and any property price.
So no cap on price?
No cap on price.
Do you understand what this does for property prices?
Yeah, pushes them up. I mean, it does nothing other than push them up. Maybe one thing it does is allows people to, let's say someone's looking to buy in, I don't know, an upper class suburb like Blackburn, let's just say. So instead of going out to Nunawading or Mitcham,
right,
maybe they can now afford that extra 50 or 100K to stay in Blackburn.
Right.
I don't know. Maybe that's a stretch.
Could it be at all possible that the fact that they've put their hand up at an auction meant that someone else said,
absolutely.
Yeah, I'll top that.
Well, and I mean, you're assuming that
come on, man,
the first home buyer is missing out because of 50,000 and the person that won didn't have another 150, 200K.
If you're spending 1.3, 1.4, 1.5 million, 1.6 million,
what's 50?
What you reckon 50 grand is going to make you is the deal breaker for buying or not? It's ridiculous.
No, well,
so what do you think?
It depends how disciplined people are.
So what about what do you think about this whole concept of don't touch the super pot?
I really don't. I kind of think it's a bit overblown, to be honest.
What is?
The potential risk to your super. Yeah, there will be an impact, but you're going from one asset to another. Yeah, it's not like...
So you're allowed to invest in Peloton that fell 93%.
Or have an SMSF and buy an investment property, but you can't use it to buy your own home or part of it. And I like that there's a cap at both percentage and dollar. I think maybe that kind of makes sense. At least they've thought about it. But I don't see the issue. Again, you get to retirement, you sell your home and downsize, put that money into super. So assuming you haven't lost money on your home, which over a long period of time you're highly unlikely to, I don't see the problem. I really don't.
I think it's an unnecessary policy. I don't see it being an issue. I don't see an issue of all the critics that come out and say, get your hands off people's retirement savings. I reckon that's a whole lot of bullshit.
Where do they work?
Hey?
Where do those critics work?
You take
For
a
an
guess.
industry super fund, maybe?
Or other financial advisors.
Financial advisors?
Because financial advisors typically are not people who typically most of them are focused on liquid assets and managing portfolios. So at any point in time, once someone can get their hands on their assets and move to an asset class that they can't charge assets under management on, of course it's actually detrimental to them and to their business.
Yeah.
And so I agree with you. I don't think there's an issue with it, but I think it's a completely unnecessary policy. In what?
Well,
to the extent that it's going to push prices up even further. That's that for me, I think is the biggest issue.
Yeah.
And what we are not doing is we're not addressing the problem, which is supply.
Sure.
Until you address supply, you can keep handing out all this money, giving out all these grants and all these bullshit policies, but all that's doing is pushing up prices. That's all that it is doing.
Yeah.
That's it.
Yeah, you're right. And it's like the first home buyer deposit or whatever it was. I can't remember that. I mean, that's all it was. Your prices just went up by $5 or $10,000, and
first home buyers grant,
just
stamp duty relief, all of those things, they just push prices up. And guess who's advocating for this? The banks, mortgage brokers. They're great policy.
It works for us. Industry Super Australia, which is the mouthpiece, I guess, for the industry super funds, they came out and said it was a bad idea. Don't let people take money out of super.
Give it to us instead.
Keep it in our funds. I mean,
everyone's just
as if they're not conflicted. But the Grattan Institute came out and basically shot down ISA's modelling, which I thought was pretty interesting, quite funny. But yeah, I mean, I think there's no reason not to be able to use your super. I do agree with you though. All it does is push up prices. And supply is an issue, and supply's been an issue for forever. I mean, how long has supply been an issue in Melbourne and
no one wants to
CBDs?
take a long-term view on releasing land, developing land, the infrastructure that comes along with it. That's a long-term thing.
Yeah,
and also
it takes we
are so concentrated. I mean, you're in the US.
Yeah.
Is there one? So in the state of Victoria, there is basically one major city, Melbourne CBD, and that is it. Mm-hmm. Whereas in the States, you've got lots of little cities all around the place.
Lots of little cities that are 2, 3, 4, 500,000 people. I mean, they're not little. Sure. Like California, you've got San Diego, LA, San Francisco, and you've got a bunch of other places that are 1, 2, 300 per thousand people. So
I think building those hubs. And the governments there's been a lot going on in that. You look at the likes of Box Hill, you look at Dandenong and Footscray, Geelong. Bendigo,
Ballarat, like those regional hubs, and I think that's the answer. Improve transport. These fast trains that have been talked about forever that stop at 5 stations.
I think
make
it's
them
a transport
express.
and infrastructure.
I think it is.
The bottom line is the more money you give people, the more they will spend and bid. It is 100%. Fact. That is the bottom line.
Yep.
Should we move on?
So house prices
cover
going
anything
up. What's his name? Chris Joy. You're probably wrong. Yeah. Assuming, of course, the Liberals get back in.
He did say though. I saw a post. He said that the new government policy means that we need to change our modelling.
Oh, okay.
Yeah. So he came out and said probably not going to be that.
This will be all after the fact because the election will have been decided, and no doubt it's just. I don't know.
But I think what it means that your property prices aren't going to capitulate. Sure, I think they're going to keep coming.
Well, what is Labor's strategy? Policy? I don't know. I haven't paid attention.
I forgot there was an election.
Who knows what it is? I don't know. Anyway,
are we moving on?
Yeah, mate.
Do you have anything else? Let's talk about being cashed up. I want to bring this first chart up. I don't know if you saw this. It's on Bloomberg. Abundant liquidity. Hong Kong's financial system is flush with cash. Look at that. Going back to the late 90s, we are seeing an enormous amount of cash. Hong Kong's financial system is absolutely cashed up. And I think Hong Kong's a country that sits with the US on one side, has influence with everything that's going on in the US. It has China on the other side with their economy just sputtering.
Does the US have influence there anymore?
Well, I think Hong Kong's kind of seen as this sort of place where you can come in and go, kind of.
Yeah, okay.
And so getting in and getting out has been relatively easy.
Sure.
And so we haven't seen this level of cash. We've never seen it. But also, we've also never seen, and I'll get this second chart up now, is foreign currency buffers dropping. The previous chart, I don't know if you saw it, there was a slight dip, but now you're seeing money absolutely flowing out of Hong Kong. So what happened was during the GFC, a lot of companies repatriated money back onshore just to shore up their balance sheets. And now with everything that's going on with the US and with China, money is just flowing out. The thing I don't know where the money is going. I think that'll be really interesting to see and to find out. Possibly into the US with, as you can see, with US cash levels ridiculously high as well. So that's something that I thought was quite interesting, that everybody is cashed up. Further to that, I don't know if you saw the Bank of America fund manager survey come out recently. And I'll get this first chart out, which is showing global growth optimism, which is at record lows. And it's showing the net percentage of fund managers are expecting a stronger economy. And so you look at that number on the far right-hand side in May 2022, basically it is at the lowest reading that this ever goes back to from 1994.
So this is fund managers' expectations of a percentage of fund managers who expect a strong economy.
Correct.
So that's negative, 70?
Yeah, so the net number is negative, right? And so you've got everyone pessimistic about the economy going forward. And I'll talk a little bit about this shortly. This next chart, which I thought aligned really well with that of the chart of cash in Hong Kong, these are B of A's clients that are hoarding cash at the moment. And we haven't seen these levels since 2000.
Yeah.
So on the far right-hand side, we have now surpassed that of 2020. We had the double dip recession fears in 2011, 2012. I think interest rates started rising in 2016 for a brief moment. I don't know what happened in 2003. But then you've got the 2000, 2001 cash that's being hoarded. I'm curious to ask you a couple of quick questions, but let me just go through these charts. Then we've got consumer sentiment. Have a look at this. Consumer sentiment dropping. The red shaded areas represent a recession. We had in 2012 that double dip recession fear, which never eventuated. Yes. That is the only one that I can see that we get that low and we don't have a recession. And I said before, like maybe we're in a recession right now, and then when we run this chart again in 6 months' time, there's a red band that shades that dip all the way down to 60.
Yeah, maybe.
Wow. But it appears. I mean, could we have this double dip fear as we had in 2012? Maybe. I just think that the recession during 2020 was so short, so sharp, so recessionary that maybe doesn't count.
Yeah.
And so, yeah, sure, the probabilities are weighted that there will be one. And then finally, I've got this chart which shows consumer sentiment, and so that's why I showed you the chart before. Consumer sentiment, the subsequent 12-month S&P 500 returns. So the average is 85.6. That's the average consumer sentiment. Okay, this goes back to 1971.
Yep.
I'll just give you some examples here. February 2020, consumer sentiment was sitting at 100. The following 12-month return in February of 2020 was 31%. Does that make sense on the top right-hand side?
Oh, there. Okay. 2020, yes.
Yeah, and so let me use an extreme example. Go to August of 2011.
Yeah, right.
So consumer sentiment is negative, is sitting at about 55. The following 12-month S&P 500 return was 15.4%. Have a look at January 2007. Consumer sentiment sitting pretty strong. S&P 500 returns negative 4%.
There's no real correlation here, is there? I mean, you've got periods where consumer sentiment is high and returns were negative, it's high and returns are positive, and vice versa. But
I think the interesting takeout for me is whenever we see these extreme levels,
sure,
go all the way to the bottom left-hand corner, February 1975, you're sitting at 58. that is the end of the recession, right? And so everyone's feeling sentiment's the worst at the absolute end
Best
of
time
the
to be
correct
investing.
And so the stock market was up 22%.
Yeah.
Have a look at 1980, up 20%. October 1990, up 30%. 03, up 32%. 05, up 14%. 08, up 22%. 11, up 15%. 2020, look at that.
Oh.
Now remember, in February is when the market peaked.
Feb? Yeah, it was around
and then
there,
it only
something.
lasted a month, and then it bottomed out on March 23rd. And so forget that one. I don't think anyone could react. But have a look in April. Look at the consumer sentiment sitting at 70 or so. So consumers were super bearish after the recession had already finished, the market had already bottomed, the stock market had already rebounded, but no one bought that. No. And stocks returned to 43%. And so now we're sitting at 59.4 on the consumer sentiment index. The reason I'm showing this is that to me, when consumer sentiment goes this low, the probability of a relatively strong 12 months following is pretty high.
Pretty high, yeah. Yeah, it is. And, it's interesting, and I'm sure a lot of people are in this situation where you look at all this, all the evidence and all the historical, 70% of the time, 80% of the time, this is what happens, the markets go up and da-da-da. I don't know. I can't help but escape this, but is it different this time? Is this the 20%?
So
let me... the period where we're raising rates and consumer sentiment is falling, we've seen spending starting to fall, inflation's still going up.
But I think you've got to work on probably...
Has it got a little bit more to play out before we hit that?
Maybe.
And it might be.
Probably does.
And
but I don't think investors should be looking at things in a binary outcome. I think looking at things probabilistically is the way to look at it. Let me bring this one more chart up. And so this is shout out to Ridolt's Wealth. Michael Batney put this together. And so it's looking at from 1950 forward 1 year stock market returns after a drawdown like the one we have had.
Yep.
Okay. And so have a look at the drawdown that we have had is that red line, dotted vertical line. We are here. So you're down about 20%. And so on the left-hand side, you can see on the vertical axis there, the returns 1 year later. And what this is showing is that there are outcomes that historically have shown that the stock market has returned up to 60% the following year.
Yep.
Or as low as, I'm calling that 30%. And so anywhere between you're down 30% and up 60%, I mean, isn't that all sort of asymmetric returns? Like, don't you want your upside to be far greater than that of your downside?
Yep.
And so the average numbers the average return was 13%. And again, talking about probabilistic outcomes, it was positive 86% of the time.
Yeah, right. Okay.
I don't think that's bad, man.
That's not bad. And when you think about, just looking here, so the average return's 13, the average over the entire period is 9, so higher than average return, and the probability is 74% over all times, 86 when you're at this point.
Correct.
So, yeah, I mean, the odds are absolutely stacked.
Do you roll the dice?
In the favour. Why not? Maybe not for everything, but you start taking positions, work money into the market. Because we saw, Feb. So January wasn't great. Feb peak. March wasn't great.
We had a bit of a little
April,
bounce. We had a little bounce.
I mean, we up until
May.
Tuesday. I think Friday, Monday, and Tuesday were all looking really strong in the US, and there was that talk of here's the bounce, and then bang, back down again. And that's what you get during these periods.
100%.
So much uncertainty. Everyone's just relying on what the Fed is saying, what data is saying, and so there's no clear direction. So you're going to get 3 or 4 days of good returns, and then a couple of shockers that just knock the stuffing out of you. And we've seen that in crypto, we're seeing it in bonds, we're kind of seeing it everywhere. We've got to be, at some point we'll get to that low point. We won't know it until after the fact. But I think if you're just working money into the market during these periods, in 3 or 4 years' time, you're going to look back and go, man, that was a good move because now I'm up.
You are guaranteed to pick the bottom, and you are guaranteed to miss it as well. I reckon if you're doing like a dollar cost average.
Absolutely.
You know, if you're putting in a specific dollar amount every month, but I think you need to do it. You need to automate it. Because if you say, we'll talk about it, it's not going to happen.
Take the emotion out of it, go systematic, and just let it happen.
You'll find a reason not to do it.
Yep.
Bill, I'll close on this quote from Bill Miller. When I am asked what I worry about in the market, the answer usually is nothing, because everyone else in the market seems to spend an inordinate amount of time worrying. And so all of the relevant worries seem to be covered. My worries won't have any impact except to detract from something much more useful, which is trying to make good long-term investment decisions. I thought that just summed it up really, really well.
Yep.
Look, we're not going to know. We could be in a recession right now. We could have another 20 or 30% to go. But I think if you cashed up, I think it's an opportunity to cautiously get into the market.
Money that you can afford to lock up for a period of time.
Yep. Let's quickly touch on a couple of director's cuts and we'll wrap up.
All right. So which one's this? Unprepared, Rob. Okay, so, that's right, Shanghai. So we're looking at car sales in Shanghai, which I think this time last year or during the month of April last year was 26,311.
In what, in a month?
In 1 month of April. So that's a pretty healthy number. That's probably
2022.
What Australia sells for the full year. 2021, April 2021. 26,311 vehicles sold in the city of Shanghai alone. 2022, I would ask you, what do you think? But I know you've read it.
I've read the article.
Zero cars were sold in a city of 25 million people during 1 month. I mean, that's just
why aren't they buying cars online? They physically can't go to it.
I don't know, man. They can't get out.
Google's been blocked in China.
Yeah. So that's just pretty crazy. And I think that just sort of speaks to the period that, that they're going through, that the COVID zero pursuit that the Chinese government have undertaken. But that's extreme. I mean, that is just unheard of. Yeah,
it's massive. Gucci, Adidas's leaky $1,644 umbrella faces backlash in China. I'll get a photo of this umbrella up. It is the Gucci Adidas umbrella. It looks pretty
Gucci and Adidas.
Pretty
to me.
Gucci and Adidasy. It certainly does. And it costs a mere $1,600. The problem is
US dollars, I'm assuming.
US dollars. The problem is, unfortunately, the umbrella is not waterproof. And so somewhat useless.
Slight oversight.
But Gucci and Adidas have come out and said, no, the umbrella is not designed to protect the user from, the carrier from water. It is designed to block the sunshine.
Of course.
But I don't know where the Chinese are going right now if everyone's locked in their house and who's buying $2,000 umbrellas. But I don't know, man. That just seems absolutely ridiculous to me. And maybe that is the absolute peak of this strong market. Surely. This has to be the telltale for the peak in the market.
I love the comment that products were not intended for the common folk. Far out.
All right. Anything else on that, or should we wrap up with tips and recommendations?
Let's wrap up. All right, tips and recommendations. So we're sitting down with my son earlier this week, Lucas, and asking him, what are we going to watch tonight? And that was my first mistake. So he chose a new Marvel series on Disney+. Now, full disclosure.
Can my kids watch it?
I'm past... Yeah, I think so. Well, so far, I didn't get through it all.
What's it rated?
I'll have a quick look. I couldn't remember the name of it, so I had to actually bring it up. And it's probably going to start playing. And it's rated M.
Yeah, it's definitely not for our kids.
No? All right. So that was my first mistake. I'm not really into the whole superhero thing, but plenty of people are. So it's called The Eternals.
Oh, yeah?
So I from his comments and my understanding, it's the kind of the next series after, they killed off a whole lot in this. I don't even know, man.
I don't even know who's part of these gangs.
Right? Like Angelina Jolie's in it. So that was the
that why you're watching?
That was the only person I recognised.
Of course you recognised Angelina Jolie.
No, because I looked at her and went, wow, she looks really familiar, but I just couldn't put my finger on it. She looks quite a bit older in this movie. Anyway, I'm sure it's all makeup and designed to be. But anyway, look, it was reasonable. So if you like the Avengers, that's it. They killed off a bunch of the characters.
I don't know, man. My kids know all about it. They know what gang Hulk is part of, what gang this guy. Right. They know it all. I don't know.
Anyway, so the Eternals, that looks like their next Avengers type gang, and there'll be tons of spin-offs, I'm sure.
Cool.
And they'll keep making tons of money off it. Look, it was all right. It was entertaining. I think we got halfway through and it hit 10 o'clock and I said, dude,
bedtime,
get to bed.
Yep, 100%.
Anyway, so that's what I got. I'd be interested to hear what other people think about the Eternals and whether I'm just completely missing it. I don't know.
All right, flick us a text or an email. What do you think about the Eternals? Or comment in on YouTube. I'm looking forward to one day watching all that stuff with my kids because they love it.
Yeah,
love it. But just I don't know what could just pop up in the middle of a scene somewhere. So,
well, it's hard because I sit down and go, oh, "What do you want to watch? What about this? I've seen it. What about this? No, I watched that." Like, man, you guys spend way too much time on your freaking devices. Totally. But anyway,
well, I might be a net subscriber loss. I might add to the tally.
He's out.
No, not yet. Deb said last night. She said, "Oh, we should just cancel our Netflix. We never watch it."
Yeah.
And I thought, am I going to contribute to the net subscribers? We haven't been watching much TV, man. As you know, I'm just spending some time on my own this weekend, and as part of that, I need to do a detox. I haven't had a coffee for the whole week.
It's been a rough week for Rob and for all of us.
Yes. It actually has. So I'm not supposed to eat bread, and so I kind of know how you feel. But I have a recommendation for you.
Oh, okay.
Have you ever been to the Honey Thief Bakery on Canterbury Road in Blackburn South?
No.
Okay. There is...
All right. I'm Googling.
There is
as we speak.
Have you ever had nut and seed bread? You can eat nuts.
I can eat nuts.
Man, they've got this nut bread, and it's like a loaf of bread, but it's basically made from nuts and seeds. It's really it's like a big brick.
Okay.
And you sort of slice it relatively thin. You can toast it. Man, I had some last night because I can't have bread. And Deb has it all the time. I've never tried it. But it was really, really good.
Okay.
So if anyone's in and around Blackburn South, Canterbury Road, the Honey Thief, they're quite a popular bakery. They've won a number of awards for their baking and for their sourdough breads. So you should go check it out. It's pretty good.
Definitely check that one out.
And it is vegan, gluten-free, paleo, and I think potentially keto.
Wow, so trendy. In Blackburn, what the hell?
In Blackburn. It sounds like a bread you'd sell in Fitzroy.
Yeah, but, absolutely.
It is right now backyard.
Did you know The Honey Thief was a song by Hipsway? I only know that now because I just Googled Honey Thief. And I was like,
we're learning every day.
There we go. So anyone that's still with us, thanks for listening. Thanks for making it to the end.
Hit us up. Flick us a note and subscribe on YouTube because all this stuff comes straight through to you and you get a little note to say episodes out. And thanks to all the listeners and everyone that's been flicking us comments and notes. Really appreciate it. Hit the subscribe button, flick us a note, and we'll catch you next week.
Cheers, guys.
My name's Robert Baharian, and I'm the founder and CEO of Baharian Wealth Management, AFSL 526798. The information contained in this podcast by me, my colleague Matt Rigby, or any of our guests may include general advice and does not consider your personal circumstances. You should seek personal advice from a registered financial advisor who can consider whether the general advice is right for you.